Hi, this is the continuation of the financial statements, part two, and we are uh, part two of the balance sheet because we already talked about the income statement before and did the Excel exercise of income statement before we went online. And so now we are on, we've been discussing the balance sheet since last class. And in our last session, we ended our session by discussion of uh, promissory notes and accounts receivable. We established the difference between promissory note and accounts receivable, and that also we talked about uh, what is the physical side of the accounts receivable, right? And I said, since accounts receivable, by definition, is it's only a definition, as I said, by definition, it's a concept. It's something, it's uh, the payment you haven't received yet from your sale, right? And I explained why it can happen. And it's a credit sale, basically, right? But unlike the promissory note, which is a credit sale initiated by the buyer, uh, and which is also a concept as well as the um, physical form, which looks, like a check, but um, uh, physically, it looks like a check, but the difference between the check and the promissory note is that the promissory note carries interest, and it has maturity on it, right? Uh, Maturity date. In other words, the date when they will pay, when upon upon presenting the promissory note, right? Now, and also, a promissory note is called commercial paper, right? So, promissory note is a commercial paper, right? It's a physical uh, form, whereas accounts receivable is only a concept, and the physical form uh, that accompanies that idea is invoice. And I told you that's what So the promissory notes and accounts receivable are both, they can be, and I also talked, we discussed that they can both be discounted. In other words, if you are holding, uh, if you are holding a promissory note or invoice, right, that matures in 60 days, right? You don't have to hold it until maturity. I mean, if you hold it until maturity, right, then in case of promissory note, since it has interest on it, right, if it is 10% interest, and uh, the face value of the promissory note is $10,000, right? Of course, what 10% would be the annual interest rate. So for 60 days, remember, you have to, in a simple interest rate model, you have to make that adjustment, 10% over times 60 days over 360, right? But ignore that just for the simplicity of just for the sake of the simplicity of our thought experiment, we'll just assume 10% for 60 days. Then if you hold it for 60 days, you're entitled to $11,000, and you present it to the issuer of the promissory note. you will receive $11,000, right? But that is, uh, but once again, that is not that's not the uh, case in general, because no one holds the promissory note until maturity. I mean, companies that don't have any cash flow problem can hold promissory note until maturity, but most small businesses uh, are constantly plagued with uh, cash flow shortage problems, so they cannot hold onto it for until maturity. So what do? They take it to a bank or a financial company that specialize in buying promissory note, right? And I said that's called factoring, right? Negotiating. Basically, they negotiate the sale of uh, the promissory note, right? And this, we talked about this in the uh, simple interest and simple discount, because we did already simple interest and simple discount. We're not gonna go extra length, right? Uh, on this topic, we talked about what factoring means, where the word factor came from, and the word factor um, comes from the oh maybe we didn't talk about the word factor, but the third party financial company that specialize in buying promissory note are called factors, right? So that's why it's called factoring. But the concept is basically discounting the promissory note. Remember in simple discount, simple interest, simple discount topic, how we discount the notes, promissory notes, right? Using discount rate. Now, that process is called factoring, and the factor means actually in French the word la facture, right? In Italian, la fattore, or uh, even in Czech and Dutch, they have similar words like factura, facture. Uh, all these words basically mean invoice, right? So basically, the word factoring means, trading invoice, buying and selling invoice. Uh, Actually, when the company takes this promissory note to the bank, uh, they don't, they're not waiting for 60 days. Um, there, some companies may hold it for the first 10 days, and on the day 11, they are hit by a severe cash flow issue, so they take it to the bank and factor it on day 11. But anyway, the process of discounting is something we already talked about in the earlier topics of simple discount. So, and basically, promissory notes and invoices are discounted or factored in the same way. And that's what we talked about. And so in our example, right, we already understand what physical assets or non-current assets or real assets are, and then so in the current assets we discussed every other line item. We just have inventory, talk about. Uh, and the inventory consists of, for manufacturing business and for retail business, inventories are slightly different. I mean, manufacturing's inventory is quite comprehensive because they are manufacturing. They must have raw material, and then that's the inputs of production, right? And so that goes into the production process. And at the other end, right? Um, at the other end of the production process comes out the finished goods, right? So um, there are two types of inventory already in manufacturing, and the third type is goods in process, right? Goods in process is like the middle state, right? Half assembled or in a partially assembled state, right? It's in between, right? Raw material and finished goods. But now think about it. Um, for manufacturers, right? It's not only the finished goods that has value, right? The raw material has commercial value on it. Raw material, because you paid for the raw material, right? There is dollar value on the raw material. And since it came from your working capital, in other words, what's the working capital? Working capital is the current assets. Another name for current assets is working capital because um, uh, the working capital supports the production, the operating activity, right? Until the first batch of goods, your finished goods are sold and revenue comes in, right? Uh, uh, that's called working capital because it's for the business to operate until it gets its first revenue. So basically, you purchase raw material from the using the working capital. So you have to keep track of that, right? You have to keep accounting of that raw material, and some of it went into a production process. So some of the raw material came out as a finished good, and the finished goods have increased in value because there is value added to the finished good, right? In other words, the finished goods value is not just the sum of the parts, the value of the parts, right? In other words, the whole is not equal to simply the sum of the parts because you just put together the parts and components. It doesn't become a computer, right? You have to assemble it in a particular, very specific way, right? Otherwise, it's not gonna uh, work. So one end of the production process is finished goods. The other end is the raw material. And in the middle, there's goods in process or the work in progress. Now, the goods in process is also, it's hard to put dollar value on the goods in process. Of course, you cannot put, a retail value on the goods in process because it's still not a finished good. It's just simply, partially assembled state. But at least you can put like, raw material value on the goods in process, right? Uh, of course, if you think about it, until up to the point until it gets half assembled or partially assembled, still labor went into that, right? Also, capital went into that. So even if uh, not quite a finished good, but you still it's not simply the sum of the raw material or the direct input cost, right? There's got to be some But anyway, if push comes to the shove, at least you can use raw material value on the uh, for that. But anyway, so I said, in manufacturing there are three types of inventory: raw material, goods in process, and finished goods. But in retail, there is only one type of inventory, and this is basically by logically and by any rational thinking, you can easily tell it's only finished goods because it's retail. In retail, you have only finished goods. You cannot have raw material or goods in process in retail, right? All right, that explains all the line items in the asset side. The other side, the liabilities and equity side. Um, of course, the liabilities and equity side largely consist of uh, liabilities, and the total liability in this example is this number, 5.75 million, and then equity, 5.855 million, right? Equity is 4 million, right? Uh, so together, it's going to be, 9.855 million, right? That's basically why it is, the assets that should be equal to the asset side because they have to balance out, right? Now, let's think about the total liabilities. Liabilities break down into current liabilities and non-current liabilities. Non-current liabilities are also called long-term liabilities, long-term, right? Um, or and the current liabilities are also called short-term liabilities. Now, long-term liabilities have long-term maturity. In other words, longer than 1 year. So they are generally, bonds, right, and mortgage, right. Current liabilities are basically short-term debt. These are long-term debts, short-term debts, and um, short-term debts are actually, credits, right? Short-term debts are generally credits. Um, now, and they mature within 1 year. In other words, the payments must be made. Payments must payment. These are payment obligations that mature within 1 year. So payment obligations mean uh, some of them are accounts payable, some of them are notes payable, some of them are interest payment, some of them are accrued wages and accrued taxes. What does that mean, accrued wages and accrued taxes? I'm going to get to that later. But first of all, uh, uh, these line items in the current liabilities do not all mature in 1 year, right? I mean, they mature all within 1 year, meaning, some of them can be in 1 month, some of them must be paid in 2 months, some of them may be paid in 3 months, 6 months, right? 9 months. But the point is, uh, their payment is due within 1 year. Now, first, accounts payable is what? That's the opposite side of accounts receivable. Now, think about it. Accounts receivable is our credit sale, right? Initiated by us, by the seller, right? That we discussed here, right? Uh, so that means, if Dell, the manufacturer, computer manufacturer, purchased, 1,000 mice from its mouse supplier, with whom they are in a binding supplier contract, for like 2 years or 5 years or 3 years, right? So I said, I gave you an example of just-in-time inventory, right? Uh, so the supplier of the mouse simply ships the mouse, 1,000 units of mouse, when the inventory level of the mouse at the end of at the Dell's end hits low bottom, right, or threshold level, then this supplier, this small mouse company that makes mouse, right, automatically ships 1,000 units to Dell so that it's not going to delay their production schedule, right? That's just in time. And that way, Dell doesn't have to build a warehouse. Building a warehouse costs them money, and also maintaining a warehouse also costs them money. So that Dell wouldn't have to deal with warehouse, right? They save on warehousing cost and uh, inventory carrying cost, right? Now, so if Dell has 1,000 mice delivered to them, shipped to them, then uh, the they will receive an invoice. This invoice for them is accounts payable, right? Now, what is notes payable? So if Dell initiated credit sale from their end, so they went to the mouse manufacturer, not their usual or the supplier that is in binding contract with them, but went to someone else and bought keyboards, right? They bought 1,000 keyboards, right? And then they paid with promissory note. So then they would have notes payable, and they are all like I've been telling you that the maturity on the uh, maturity on the promissory notes or invoice, right, are on average about 60 days because theoretically it can be up to 270 days, but nobody would take something like that. So on average, it is somewhere between 1 month to 2 months, right? Now, it's quite obvious what interest payment is because when you have long-term debt like bonds and mortgage, you'll have to pay interest, right? And let's see how this interest was calculated. It is certain percentage of that. So F12 is total non-current liabilities. L27 is the interest rate was assumed here, I believe, in the income statement, right? Yeah, we use this. Okay, it looks like we assumed quarterly operation, right? Because um, annual rate is assumed to be 2.5, and I multiply it by 1/4. That means this looks like quarterly operation, right? Result of the quarterly operation. That's why. So anyway, back to interest, right? Again, now think about it. We assumed across the board, right, regardless of bonds or mortgage, 2.5%. Now, this is a simplifying assumption, right? Think about it. Bonds and mortgage, they are separate instruments, right? Debt instruments. So uh, most likely they won't have the same maturity, they won't have the same interest rate. But 2.5% was uh, like average of the two, like weighted average, right? Weighted average. So anyway, that makes sense. What's the accruals? Accruals are generally accrued wages and accrued taxes. And accrual means accrued wages. Now think about it. if you work, right, you get the paycheck, right? Um, your paychecks are usually either bi-weekly or monthly, right? Suppose you're getting a monthly monthly paycheck. Usually, and let's say you're getting the monthly paycheck at the end of the month, right? Or if you're getting bi-weekly, you normally get it on Friday. Okay. Um, and also, if it is monthly, you get it on the like certain date, like 25th, not necessarily the 31st or 30th. Um, but then think about it. If you're getting a bi-weekly check, uh, so that will be Friday, right? But suppose the end of the month is not Friday, but let's say the end of the month is uh, Wednesday. Okay, if the end of the month is Wednesday, but they have to close the book at the end of the month. Closing the book means it's just metaphor. What that means, uh, uh, they have to settle the account. In other words, uh, they cannot keep it open. They will have to um, update. They have to bring it to a closure so that they would have all the total numbers, right? And then as they move on to the first day of the next month, then they will have all the updated account, right? All the updated accounts. So they have to uh, they have to calculate how much wages have accrued until that Wednesday. But think about it. If accrued wages until Wednesday is 5,000, right? But has the paycheck gone out? Have they sent out? Have they sent out the paycheck? In other words, accrued wages until Wednesday, 5,000. Have they paid it? No, they haven't paid it. In other words, payday is Friday, and you will get a check on the Friday, and it will include the wages from Monday through Friday. Make sense? Not Monday through Wednesday. So no transaction has happened. In other words, the paychecks didn't go out. So no transaction of, uh, in other words, your paycheck hasn't been concluded yet as a transaction, right? But since they have to close the book, they will have to uh, think about it. Everything, all the numbers in the line items, in all the numbers in the balance sheet or income statement, mean they have been concluded. In other words, transactions have been made. So actually, this number is still in the number that has accrued only up to that point, right? Not the number that actually has been transacted, right? Not the number that has been concluded. So that's what is meant by accrual, okay? So, therefore, that explains, everything about the uh, liability side. It's quite obvious what non-current liability is. Equity is, we already know, shareholders' equity. Shareholders paid in this equity. It's called paid-in capital. Now, our next question is then, what is the one thing? The first thing I told you, that in accounting class, the first thing that you will here, and then you will learn about the assets and liabilities, is that the assets are what you own and liabilities are what you owe. But once again, but then liabilities and equity are on the same side. Now, you understand, equity is not what you owe. Actually, as the owner of the company, equity is what you own, right? Free of debt, right? Uh, but it's not as I said, so it's not very, it's not really uh, complete to define assets and liabilities in terms of, it's not entirely wrong, but it's not complete to define it in terms of owning and owing, right? But I told, but you can still understand it as, liabilities and equity are the sources of the fund or source of the capital that is, that has been used to acquire all of these. So, asset side is how the capital was used. The liability side is how where the capital where it came from, how it was raised. But again, if you look at it from the shareholder's perspective or owner's perspective, equity is not uh, what you owe, is what you own, right? But uh, again, if you look at it from the company's perspective, right, equity is what the company owes to the owners, right? So that's an interesting thing. Why? Because you can look at it that way, but then what is a company? Company is not a company is a legal person. A corporation is a legal person, but company is not an uh, animate entity, right? In other words, company is just a vessel for um, the owners to it's a uh, cash machine, right? Cash generating machine, right? A vessel for for the owners, right? I mean, company is not an animate entity; it's an inanimate entity, right? It's just a legal structure, right? So, if think about it, if you owe something to someone, you have to eventually uh, uh, pay it back to that person, right? But think about it. Uh, that means uh, company owes equity to the equity holders, but the company is owned by the equity holders, right? So then that means the owners own the company that owes equity back to the owners. So what is that, right? So that's why I, don't consider that explanation very. I mean, yeah, you can consider a company owing equity to the owners, but that's just a tautology. In other words, it's just feeding back to itself, right? Anyway, so here let's go into let's delete clear out all these sums, right? Clear out all those sums and which is quite highlighted cells, which is quite obvious. Now, let's think about, let me blow it up a little. Okay. So let's fill in those blanks, okay? And which is not very difficult, right? Um, First of all, all of them, no, first, if you made a sale, right, the revenue, if the revenue is all in cash, right, it will be reflect in the balance sheet, right? It will be reflected here, right? Whatever, the revenue uh, is entered in the income statement, that would increase the, if that's all cash, that will increase the cash balance as much as a sale. But the sale, most of the business to business sale are not in cash, but in promissory notes or accounts receivable. So then what's going to happen? That's going to increase the accounts receivable or the promissory notes, right? But that's at the end of the year, right? Because I told you you need two balance sheets and one income statement. And what because you need the balance sheet at time 0 and at time 1, right? At the beginning, at the end. Now, income statement is always as of the end of the operating period. Isn't it right? It's always as of the end of the operating period because at the beginning of the operating period, you don't have any profit or loss, right? Um, Now, so if this is the current assets, total current assets is simple. All you need to do is using, this the easiest thing, using the auto sum, right? You can simply find the auto sum. And then non-current assets, again, this is, you can sum this, but there is depreciation, right? At the end of the year, right? At time 0, there is, time 0, there's everything is brand new, so there is no depreciation. At time 1, there will be depreciation. At time 2, there will be depreciation. Now, the depreciation here is just because it's time 1, it's just annual depreciation, right? For year 1 only. But as time goes on, year 2, you will need to, because all these values were as of the purchase point, right? Time 0, the depreciation entered here will have to be the accumulated depreciation, not just that annual depreciation, but the accumulated depreciation. Now, and you understand why it is, negative, because that's the value going down. And if you look into that cell, I summed these two, right, and divided by 15 or timed it by 1 over 15. That means I assumed 15-year service life, right? And why 1/4? We are, assuming quarterly operating period, right? But then think about it. Actually, plant and equipment, building and land don't depreciate at the same rate. It's not, in other words, they don't have the same service life. Equipment and plant wouldn't also have the same service life, right? I mean, there would be different types of machinery, different types of equipment. So they would have different service lives. So they won't be depreciated at the same rate. And besides, building is depreciated, but not the land. Land doesn't get depreciated. So actually, we should uh, separate land from the other categories, other line items. But just for simplification, I just assumed, average depreciation rate, and I didn't exclude land because there was no way. I mean, according to this, we can't tell how much is of that is land and how much of that is building. So we just, used the simplifying assumption. Okay, and then of course using auto sum is not a difficult thing. Simply using auto sum, right? You can find that, right? And then what is miscellaneous adjustment? We'll get to that later. So then total assets, yeah, I'm gonna, nothing showing here because, I collapsed the column, but if you double click on that, right, it's gonna expand, fit the column width, to the content, right, width of the content, fit the column to the content. Now here, what is that? Well, that's the sum of the current assets and non-current assets. So why didn't I put it there? That's total assets, so right? Why did I put it there? I didn't put it there because if I put it there, then it must be equal to the total liabilities and equity, right? But is there any guarantee that they will actually balance out? I mean, they are supposed to balance out. They should. They must, right? They must balance out. But then, what if they don't? Of course, sometimes it's not always automatically exactly balancing out. Why? There is always a problem with data collection. Some of the data are missing. It's not easy to uh, get the updated data, updated data. There could be so in other words, delay in data collection, or there could be some human error. There could be some inexplicable. I mean, there. Discrepancy that is inexplicable due to some statistical error or something like that. Now, once again, I'm not saying uh, we can accept a huge discrepancy, right? Of course, you shouldn't have a huge discrepancy. If there is a significant discrepancy in data, you should really go back to the source of the data and really, really, crack down the source of the error and fix the data, right? And reflect the correct data on the balance sheet and the income statement. But again, this is uh, a line item. It's also called, other assets or other liabilities. Okay, other assets, other liabilities. Sometimes, called miscellaneous assets, miscellaneous liabilities. But this is just an adjustment account, meaning when there is a discrepancy between the total assets and total liabilities and equity, and if that discrepancy is insignificant, right? What is the insignificant level? Is 1% or 1% acceptable in insignificant level or 0.1%? There is no line drawn, right? Why? Because think about it. Um, if the total assets of this company is only like 1 million, right? And then 0.1% is $100. And by $100 may not be a very significant uh, discrepancy, but suppose this company's total asset size is $10 billion, 10 billion, which is not such a big company. I mean, it's slightly above uh, micro cap, like in the small cap category. Um, Now, if 1% of 10 billion is like what? 10% is 1 billion, so 1% is 100 million. Now, 0.1% will be a 10 million, right? 0.1% is not certainly not insignificant, right? Depending on the size of the company or the total asset size of the company, right? So that's something you have to um, consider. Um, it's this at your discretion, but um, if for a company that has $10 billion total assets, a discrepancy under like $10,000 would might not be considered very significant, right? But 10,000 is like what? 0. Um, 0.1% was 100 million, right? That would be like 0.0000, right? So it's totally at your discretion, but by any common sense standards, right? You have to use a common sense standard in that case. But think about it. If that is the case, uh, we'll we can simply uh, uh, make that adjustment, right? If it's very small, right? And we don't want to do it. I mean, we don't want to do it, uh, by our own, a uh, op, uh, manual operation, right? We want the reason we are using Excel is we want to that we want to automate the process, the whole process, right? So here, let's see if we are really, if it's going to balance out or not balance out. So once again, here we the interest payment, which is it will automatically appear when we get this. Okay, so first let's find the oops, let's find the sum of uh, current liabilities. Oh, by the way, you remember another name for current assets is a working capital. So the current liabilities, the source of funds to pay for current liabilities must come from current assets. So this is the source of funds to make this payment. So obviously, you have to have bigger current assets than current liabilities. And the difference between the two is called net working capital. Net working capital, right? If this is working capital, after netting it out, it should be called net working capital. So now we use auto sum and we get that. Then it automatically populates because it was already, the formula was uh, filled in there, right? That formula, oops, that wasn't it, this one, right? Now, then total liability is what? The sum of, right? You cannot use auto sum because auto sum can be used only when you have uh, a contiguous range of data right above that auto sum. It's not contiguous range. They are, uh, and besides, it's the sum of these two subtotals, right? There you go. And equity was already given. So then our total liabilities and equity, this is just tentatively put there, tentatively, right? And if you compare that with this, they don't balance out. They don't balance out. And the difference is almost like, $400,000, which is a significant amount for a company that has, like, $10 million total assets, right? It's almost close to like 4% of their total assets. So certainly, this cannot. You have to really fix the go back to the source of data and fix the data, right? Uh, but if assuming that this difference is insignificant, we can easily fix this by we can easily take care of this by using uh, miscellaneous adjustment account. And in this account, we will use, if command. Uh, Now, probably this is the first time you see this if command or if function, but if function comes in very handy in so many cases, right? This is a very basic if function. Now let's think about it. If the number here, right, in C17, if that is uh, less than, oh, the problem arises when there's a difference. They are not equal, right? When they are not equal. And if this side is smaller than this side, we will need to put the difference, we will need to find the difference and put it here, right? When this side is smaller. If this side is smaller, then we'll have to put the difference here, right? But instead of the human being, human intervention, human being doing that, we'll let the computer automatically make that decision and fill in the difference. And so if this side is smaller than that side, then we take the difference between G17 and C17, okay? Ugh. Now, what this means is, if this, the first comma means if this is the case, then do this. Now, second comma means otherwise. If that's not the case, otherwise, just leave it as 0. In other words, yeah, there's nothing to do. If this is not the case, if this side is not less than this side, nothing to do. Okay, there you go. Now, it did something because this side, this is the case. This side is less than this side. So now we do the same thing here, right? If G17 is, that's when there is something to do. Less than C17, there is something to do. You'll have to fill in, you'll have to fill the cell with the difference. The difference would be then, if that's the case, C17 minus G17, right? Because of this thing, I cannot, again, so let's type in manually G17. But if that's not the case, otherwise, I told you second comma means otherwise, you just leave it as 0. So that's what it does. It leaves it as 0 because this side is greater than, right? This side is greater than this side. So then now we can find the total. We can safely find total that will be balanced out automatically. Here, total assets is total current assets, sum of those three things, non-current assets, and miscellaneous adjustment. Okay, and then here you put sum of. You can just, now they are in contiguous range, so you can, since they are in contiguous range, you can just highlight and select all of them at the same time. And then that means, because it's total liabilities and equity is what? Total liabilities plus equity plus miscellaneous adjustment. The colon in between means through, right? F14 through F16, right? You're summing up everything from F14 through F16. So hit enter, it's automatically balanced out. Okay, so that's the exercise on the balance sheet. We did the exercise on the income statement before we went online. So in our next class, we'll do further exercises. Okay, we'll do further exercises. All right, so that's it for this segment of the video, right? So I'll see you in the next segment of the video. Okay? And stop recording.